Part 3. The Brand Value Accounting Dilemma, Where We Are Today and Why. Hello, this is Neil Bendle, Associate Professor at the University of Georgia Terry School of Business. I'm going to spend the next few minutes discussing where we find ourselves regarding financial disclosure of brand value for publicly held companies. Looking at financial disclosures from a very high level in a company's balance sheet, you're able to find the tangible assets. These might be cash, receivables, inventory, property, plant, and equipment. Many of these aspects might be subject to estimation. Think, for instance, of a bad debt reserve relative to accounts receivable. There might also be different measurement principles used for LIFO or FIFO for the inventory. Despite these needing estimation, you would ask questions if you did not find the tangible assets on the balance sheet. It's a much different story with intangibles such as brand. This is what we call the brand value accounting dilemma. Although rules vary somewhat, the accounting standards currently in place around the world largely dictate that brands only appear on the balance sheet as a result of a purchase transaction. Consequently, most brands, such as Tide or Crest for Procter & Gamble, do not appear on the balance sheet. Brands that have been purchased originally do show, even if these brands seem less consequential to the firm than the ones that currently aren't showing. Kellogg's discloses a value for the previously purchased Pringles brand, but it does not do so for its iconic cornflakes. When brands do appear as a consequence of a purchase transaction, they're only subject to future write-downs, even if future sales double, triple. Basically, the values can go down, but they cannot go up. As an unintended consequence, the fear of future write-downs means public companies may sometimes prefer to keep disclosed brand values as low as possible. This allows them to avoid possible future write-downs. The upshot is that even when a brand appears on the balance sheet, its value may be flawed or seriously misleading. As a consequence, the current state of accounting standards and financial reporting does a relatively poor and inconsistent job of accurately measuring, explaining, and reporting brand value. In the preceding video, Joanna Seddon covered financial information for Procter & Gamble, Coca-Cola, Kraft, Heinz, and Constellation brands. Using those companies is useful in illustrating the brand value accounting dilemma. In the case of Kraft Heinz, nearly all, if not all, brands appear on the balance sheet. This is a consequence of how business combinations over recent years resulted in the formation of the current Kraft Heinz entity. For Procter & Gamble, on the other hand, a brand such as Gillette appears on the balance sheet as it's part of the 24 billion you see in the chart. This is because Gillette was acquired by P&G in 2005. However, brands such as Tide and Crest were developed internally many years ago, and therefore they do not appear on the balance sheet. Coca-Cola, a brand-driven company with market capitalization of just over $200 billion, discloses what is termed trademarks of only $11 billion. Now, all these companies are following accounting standards, but one has to question what value this provides to investors or other external users of these financial statements, and this treatment certainly does not promote transparency. In part 4 of this video series being presented by the Marketing Accountability Standards Board, Kevin Keller from the Tuck School at Dartmouth University will go more in depth into the accounting problem known as the moribund effect and how corporate management can address this concern for the benefit of investors. After that, in part 5, Frank Finley from MASB and Jim Meyer, who's a retired finance executive from Molson Coors, will discuss customer franchise strength, how marketing impacts 5 key financial drivers, and 5 compelling reasons to include brand strength metrics in financial value of brand analyses. Thank you.